Good evening, everyone, and welcome to our Building Wealth program. My name is Odette, and today we also have Ellen and Maricel with us. We're all from Plano Public Library. Before we get started, we want to make sure we go over some Zoom features and ground rules. Your mic and video have been muted and turned off. You will be able to use the chat feature, which is located at the bottom of your screen. If you select the chat icon, a box should pop up over to the side and you can type in your questions there. If you have any questions, make sure to put them in the chat box. And we also ask all participants to be respectful when making comments or questions. So today we'll get started. In today's presentation, we are going to look at, something's happening. Excuse me. In today's presentation, we're going to look at how you can build wealth and set yourself up for financial success. There are 5 steps to building wealth we're going to go over today. The first step is to learn the language. The next is to budget and to save. The third step is to save and invest. The fourth is to build credit and control debt. And lastly, the 5th step is to protect your wealth. Before we get started with the content, we want to state that the views expressed do not reflect official positions of the Federal Reserve System or the Plano Public Library. This presentation is for information purposes only. It is not intended to be investment advice. We say that seek a licensed professional for investment advice. And tying to that last point, we are not experts. Rather, this presentation will serve as an introduction to this topic. Some might already have this knowledge and some might not. Hopefully, you can walk away from this presentation with one piece of information that you can implement into your building wealth strategy. The Federal Reserve Bank of Dallas created this resource about 20 years ago because studies discovered that the lack of personal savings and good credit were preventing many people from reaching their goals to buy a home or start a business. There is a need for families to build financial capability and resilience. We know financially stable households make for a more stable economy overall. Building wealth is one resource from people from high school age to adults to help work towards financial stability. The Dallas Fed provides this resource for free in print and digitally, and you can access it online by going to buildingwealth.org. So what does financial capability really mean? Financial capability is having the knowledge and the tools to manage your money. We don't teach financial education just to check off a box. The materials here will help you make positive changes in your life. Financial education is nothing without behavioral change to go along with it. Putting actions to our dreams is what makes them a reality. Don't get overwhelmed with the big picture. Small changes can lead to big results, and focusing on a few small changes you can make this year, then you can add a few more changes next year, will help you build your wealth. A few small steps that can lead to big results is the approach that we are going with today. Our very first step in this process is to ask, what does building wealth mean to you? Some people might define wealth as being able to live in an expensive house and travel around the world. Some of us just want to help put our kids through college. Some want peace of mind instead of always worrying about money. And it's totally based on everyone's own personal values and life experiences. So now that we have defined wealth, how do you acquire it? Step 1 is to learn the language. To create personal wealth, You must understand the language. So the first lesson is to understand the meaning of assets, liabilities, and net worth. Assets is anything an individual or business owns that has commercial or exchange value. For example, a retirement plan, stocks and bonds, or a house. Liabilities, your debts, are what you owe. This may be your home mortgage, your credit balances, a car loan, student loans, or medical bills. Your net worth is your assets minus your liabilities. The simple equation to help you remember is that your assets minus your liabilities equals your net worth. Here's an example that illustrates the assets minus liabilities question. Let's say the market value of a home is an asset. The mortgage is a liability. Let's say your house is worth $120,000, but your mortgage is $80,000. That means your equity in the home is $40,000, and equity contributes to your net worth. Balance sheets are excellent in helping you towards reaching your goals. Here's an example of a balance sheet. I'd like to point out the assets, liabilities, and net worth. So at the very top, we have cash, savings accounts, stocks and bonds, retirement account balances, and there's nothing in the market value of a home. So Anthony here does not own a home. Then we have other assets, the market value of Anthony's car at $14,000, and that all adds up to $46,500. Below that, we have his liabilities. No home mortgage or home equity, since there's no owned home, a car loan balance, credit card, student loan, and other miscellaneous liabilities. So when you subtract Anthony's total liabilities from his assets, we get his net worth of $24,000. The website buildingwealth.org contains an online guide with a built-in calculator that you can play around with. The key thing to remember is that your net worth is your wealth. Step 2 is to budget to save. In this section, we will demonstrate how you can budget in order to save. Most people who have built wealth don't do so overnight. They got wealthy by setting goals and pushing themselves to reach them. Setting financial goals can help you when it comes to setting a budget and saving for your future. Goals are why you are making a budget and sticking to it. A strong why will help you when you have to make those small day-to-day decisions. So what are your short-term and your long-term goals? Think about what some of your own goals might be. As examples, a short-term goal could be pay my bills on time each month or put money towards my rainy day fund. Long-term examples include paying off my car and being debt-free in 5 years. Another one would be saving for substantial down payment on your first home. It's okay if you can't think of anything while we're going through this presentation. You'll start to figure out a few while you're going through the budgeting process on your own. Next, we'll discuss some strategies to meet these goals. That is a good question. I believe it's going to be linked in the email that they get for being registered. And if not, at the end, I'll find the link that you can access this information directly from the Dallas Bank, the Federal Reserve Bank of Dallas. Alrighty. Let's meet Gabby. She's our example throughout this presentation. Gabby thinks she's doing pretty well and she has a pretty good income, but she manages to spend it all and then some. Here we see her shopping, the sales receipts flying out of her shopping bag, a $6 coffee in her hand, and listening to tunes on her smartphone. As we go through this budgeting to save process, Gabby will realize she's basically living paycheck to paycheck. So we want to ask you, when it comes to reaching your financial goals, are you doing or wishing? The difference is doers put action to their goals, and they're much more likely to reach their goals and achieve their dreams. What does this mean? If you are a doer, you are more likely to track your spending, live within your means, stick to a budget, pay off credit cards in a timely way, deposit money into savings each month, and make regular contributions to retirement savings. Building wealth and financial freedom requires that you begin to track where your money is going, set up a budget, and make some small changes to begin to save. Here we have an example of David's day-to-day spending. You can see that everything is listed out, whether it's a large expense or a small expense. Tracking your daily spending habits is a very important first step to creating an accurate budget and the only way to really learn where your money is going. So when you start making your day-to-day spending list include purchases made with cash, debit, check, or credit or charge, as well as money that you might spend through services like Venmo, PayPal, Zelle, Cash App, etc. If you're doing this off the top of your head, you can probably write down set monthly expenses like your monthly bills, your rent, house payment, utilities, etc., things that are consistent that you always know are coming. And you probably know what your take-home pay is every month. We have these income and expense numbers right off the top of our heads, but that is not enough information to have in a real budget. You have to track your spending first. Write down your budget by using a template found on buildingwealth.org. You can also just create a spreadsheet, use an app. The trick is for you to have to write everything down, even if it just costs you 25 cents. You need to know where your money is going. You only have to do this for a month or two to see where you're spending your money. If tracking your day-to-day spending sounds overwhelming to do it for a whole month, start small and track all your purchases for a week and get motivated to continue for a full month to get a better overall idea of your spending. So back to Gabby, this is an example of her monthly budget. You can see her income at the top. Right now, we're going to look at this first column. This is her monthly take-home pay, and it totals $2,600. Here in this first column are her current expenses. So everything from rent down to car insurance, meals out, clothing, etc. It totals $2,685. You can see on the budget in the monthly net new row, Gabby's monthly net equals her income minus her expenses. So at the end of the month, she is at negative $85. She's spending $85 that she does not have every month. To stop this, she's going to make some changes both to her income and to her spending. So if we look in the second column, the first change is going to be an income change. She's going to work a small amount of regular overtime hours so that she gets $40 extra a month to bring home. Below that, we see some of the spending changes. She is going to shop for a new cable TV or internet provider to cut $20 off her bill. She is going to lower her clothing allowance for each month to $100. She is going to drive out and go out for meals less, so that will cut back on gas for the car and meals out and entertainment. So it lowers her budget in those categories, and also cutting out on miscellaneous daily expenses that just kind of happen throughout the day. When she makes all these changes, her monthly net goes from negative $85 to $125. And the important part is also that these changes are sustainable. So if you're spending $425 each month and you lower it to $25, that may not be sustainable behaviorally because you're used to these kinds of spending. So $50 is something that Gabby thinks she can probably do and sustain throughout the month. Next, we're going to look at Sam's budget. Sam is someone who lives and works in Plano. Sam is single and lives in a one-bedroom apartment by himself, and he makes about $16 an hour. Since doing his budget, he has realized he needs to make a little more money, so he is working overtime when he can, and he is creating digital content for friends to make additional money on the side. So this is his base income, take-home pay from his regular job. He has started working overtime for a small amount of money, and he is bringing in income from his digital creations. So his base income is coming from $2,400 to $2,550. So when Sam really started looking at his budget, he decided we're going to look at the middle column for spending changes. He's going to find a less expensive apartment. Good luck, Sam. We're at 915. He found one that's going to be around 890. Then he's going to look at his subscriptions. He decided to drop Hulu, so he's only going to have this charge for Netflix. Below, just like Gabby, he's going to lower his clothing allowance by half. And he's also going to lower his meals out and entertainment budget by $100. So at the bottom, you can see we have, if he keeps his current expenses the way they are and changes nothing, he's left with $7 a month. But with his new budget and cutting back on his spending, he's up to $239. As you can see, his new budget uses small changes to help add to his larger goal of saving. The same is true for you. Making a lot of small changes can add up to reaching your goals. And before we move on to steps 3 through 5, we want to take a quick pause and see if there's any questions or if we need to go over any content thus far. So we have one question. What is the most common way of lowering a budget that is sustainable? That's really going to depend on your own circumstances. And again, we are not financial advisors. But if we are taking tips from this great resource from the Federal Reserve Bank of Dallas, it's going to have to be finding things in your budget that you can lower and also that you can sustain. So for example, like Gabby, she eats out a lot and she goes out a lot. So lowering her budget completely to zero wouldn't be sustainable and would eventually not work because she's used to having weekly, daily meals out or hanging out with friends that costs money. So it's finding that thing in your budget that you can lower and that lower amount is going to be sustainable for you. And that's just going to be different for everybody. But yes. That is a great question. And if there are any more, please place them in the chat and we will address them as we go or at the end. Next, we're going to look at step 3. Step 3 is to save and invest. Step 3 in building wealth is to save and invest. Here's a tip from Dwight R. Lee and Richard B. McKenzie, authors of Getting Rich in America. Take the power of compound interest seriously and then save. The investment pyramid is made up of several parts. At the bottom, you have your financial foundation. Next, you have short-term holds, which are money that might be needed within the next 3 years or that must be easily accessed. This is money you're not going to want to take much risk on. So you'll want this in an FDIC insured savings account, savings bonds, MyRA account, or other account that you can get to when you need it. These insured accounts are no risk, but at the same time, you have low return. Above that, we have medium-term holds, which is money that won't be needed for 3 to 5 years. Next, we have long-term holds, which is money that is not going to be used for 5 years or longer. For your long-term savings, you'll want to invest in a little higher risk so you can get a higher return. At this point, you'll be ready to talk with an investment advisor and start making deposits to your retirement account or a 401k if your employer offers one. Once again, we don't give investment advice other than to do your research and speak with a licensed financial professional. And at the very top, you have high stakes. The important takeaway here from here is the foundation, the financial foundation. So what is included in a strong financial foundation? You have your financial plan and you have your insurance. With regards to a financial plan, we'll want to know our net worth. We need to set goals and make a budget, have our financial records in order, which means you have your records organized. You keep the papers that you need and you shred the papers that you don't need to keep to protect your privacy. Financial records also includes keeping records for income taxes, keeping a copy of your tax records, tax receipts and tax forms, checking your credit report every year so you can watch for identity theft, and keeping your credit in good shape. It's smart to have a strong foundation before you start investing in higher risk investments like stocks. Another important element of your foundation is going to be insurance policies for peace of mind. There are many types of insurance policies, and we'll go over more at the end. Some common ones include life, health, disability, and property and liability insurance. So now we're going to talk about mainstream financial services. An excellent first step is to get a basic checking or savings account started at a bank or credit union. Without a savings or checking account, managing your money can get expensive, paying for check cashing fees and buying money orders to pay for bills that you could easily do just through your checking account. It keeps your money safe. For example, a savings account at a financial institution is fully insured by the Federal Deposit Insurance Corps, or FDIC, up to $250,000. You can take advantage of direct deposit with your employer. You can monitor your balance online. You can access your money from anywhere. And you help build a banking relationship, an important part of your credit history. Financial institutions offer a variety of insured savings accounts. each of which pay a different interest rate. General savings accounts, they earn interest and allow access of funds at any time and movement of money from account to account. There's also money market accounts. They earn interest and they may offer check writing services and impose no fees with a minimum balance. There's also certificate of deposit. These are purchased for a specified term and return principal and interest at the end of the term, and early withdrawal fees apply. Here are a few tips when it comes to investing your money. Remember to find good information to help you make informed decisions. Make sure you know and understand all the costs associated with buying, selling, and managing your investments. Beware of investments that seem too good to be true. They probably are. Investigate financial professionals before you invest. Your state securities board provides free services to check credentials. Anyone who sells any kind of investments in Texas, for example, whether they're based here or not, is required to be registered here. And the Texas State Securities Board checks their background in a national database and verifies that their credentials are up to date. Other investment options can come through your employer. Some employee benefits include IRAs and 401ks and qualified plans. These are ways to save for retirement while paying lower income taxes on your current year's income or minimizing the impact of income taxes later, depending on the type of investment. When it comes to employee benefits, check with your employer to find out what retirement plans are offered. Many employers will match a percentage of your contributions towards retirement accounts and other investments. And if that is the case, you should put the maximum you can towards those accounts after consulting with your employer. It's a great way to increase your savings for the future. Other investments outside of the ones we've already spoken about include investing in your home and starting your own business. With regards to your home, one strategy is to pay higher monthly payments on your mortgage. When you do so, your home equity rises. Home equity in this case is the difference between the market value of the house and the balance on one's mortgage. Another strategy regarding your home is to take a 15-year mortgage rather than the traditional 30-year mortgage loan. In terms of starting your own business, you should use your skills to make money and have it be part of your strategy to build your wealth. Step 4 is going to be about building credit and controlling your debt. So now that you're budgeting, you're saving, and investing to build your wealth, what do you do to build your credit? The important first step is to know what's on your credit report right now. Even if you haven't used credit in the past, you might have information on your credit report, and it's good to check because it may be incorrect. Your credit report shows everything about your payment history, such as late payments. Lenders use credit reports, credit scores, and other information such as employment history and income history when making the decision to extend credit. What are ways you can make sure you have a payment history? Build your credit. For example, you can pay for gas for your car and any tolls on your credit card, then pay it down or off every month. This helps create a payment history and helps you utilize the credit card without spending an excessive amount of money. You can buy groceries with your credit card or pay monthly bills. The important thing to remember is that you want to pay it down or off every month. Don't spend money that you do not have. Reviewing your current credit report is an immediate action step you can take this year to get the ball rolling on achieving your goals. There are 3 major credit reporting companies, and each typically have the same information since most creditors report to all 3, and they're listed on the screen: Equifax, Experian, and TransUnion. You can access your credit report through annualcreditreport.com. This is authorized by the federal law, and this is where you can get free credit reports from all three of these credit reporting companies. Remember the definition of net worth or your wealth. It's assets minus your liabilities, and it's your net worth. Liabilities are debts. Debts reduce net worth. Interest paid on debt is not invested or saved. It is money that is gone. Therefore, it's important to control your debt. So what is a credit score? A credit score is a statistically generated number representing the likelihood that you will repay on time. The higher the score, the less risk you represent to the lender. Your credit report is used to build your credit score. Credit scores are not free, but some banks and credit companies do provide free credit scores with their account service. It's a good idea to check your score before you apply for a loan to find out if your score is eligible for the best interest rates. If the information on your credit report is accurate, then your score is accurate because it is based on the information from your report. The most important aspect of a credit report is your history of payments. Whether your payments were made on time or were they late. If your payments are late or delinquent, this will lower your credit score, which means you'll probably have to pay higher interest or even refusal. Another aspect of your credit report is the amount owed on credit accounts, which affects your score. Now that you know what's included in your credit score, let's briefly look at what's not included. Your credit score doesn't include your age, race, ethnicity, income, job, marital status, education, length of time at your current address, and whether or not you rent or own. The Federal Reserve Board of Governors publishes a guide, and there's also great info on the ftc.gov website, including a simple dispute letter to send when you find a mistake on your credit report. So once you know your score, there are ways to improve or repair damaged credit or establishing credit for the first time. Please know that recent credit history is more important on your credit score than old credit history. One option might be a secured credit card, which is a good idea for building credit. It will require a deposit, usually equal to your credit limit. And then after 6 months or a year, the secured card company will return your deposit and your secured card becomes a regular credit card. Some people confuse these with prepaid cards, but prepaid cards do not build credit. Another type of starter account may be a retail store card or a gas card. Just make sure that the card provider will report payments to the credit reporting companies. We know that credit is a good tool to have, but always ask yourself if you're ready to take on a new credit obligation. You want to have credit if you ever need it, but is it better to save for some purchases like a TV? These are good questions to ask yourself. Always think about the pros and cons of financing a purchase. Here are some quick reminders on building good credit. Develop a budget and stick to it. Getting a new credit card does not mean you have more income. Save money so you're prepared for a rainy day. 3 to 6 months of living expenses are recommended. Pay your bills on time. Keep your credit card balances low or aim to pay them off monthly. And finally, check your credit reports annually and dispute any correct information. Building wealth requires that you take steps to control your debt. All of us have an occasional financial emergency, such as the car needs tires, or the car needs to be retired completely, etc. We have some warnings about high-cost credit and predatory lenders. Payday advance loans are one type of this predatory lending. Many people who don't have emergency savings or who don't have credit available on a credit card or don't have family or friends to go to for a loan naturally think their only alternative is a payday advance loan. These generally have many extra fees, higher interest rates in the double digits, and then they tend to get out of control and deeper in debt if not paid in full or on time. Predatory lenders often target low-income seniors and adults by phone, mail, or in person. They have very high interest rates and excessive fees. You should also be aware of credit repair services that claim they can erase your bad credit. Again, if it sounds too good to be true, it probably is. Another part is to guard your identity. Never give out personal information over the phone, through mail, or on the internet. Shred or destroy old bank and credit card statements and all other private records before tossing them in the trash. Give your social security number only when absolutely necessary. Let's make it a goal to be prepared for these emergencies and find ways to build emergency savings and build credit. Research shows emergency savings of as little as $500 can remove the need for most consumers to go to a payday lender. Building emergency savings is a good first step in a building wealth action plan. If you're concerned about your credit and identity theft, a credit freeze is an option that is now available. It's brought to you by a new federal law from 2018. You can freeze and unfreeze your credit for free, and you can also get year-long fraud alerts. You can find out more information about this on the FTC Consumer Information blog, and we'll put the links to this information in the chat by the end of the program. Step 5 is to protect your wealth. As you build your wealth, it is also important that you protect it. What does that mean? Let's look back to the basics. Insurance is an important part of your financial foundation that will help you protect your wealth and assets. There are many types of insurance for yourself and your property. Let's talk about the basics of a few of them. Auto insurance. You must have liability insurance at a minimum to cover injury to other people or damage to their property. If you have a car loan, you might also be required to have physical damage coverage. Home or renter's insurance. They protect your home and possessions in the event of fire or theft, and additional insurance may be required to cover flood, earthquake, etc. A home warranty is an annual service contract that covers the repair or replacement of important appliances and system components that break down over time. Your heating, your AC, your plumbing, etc. A good action step to take every year is to review your property and auto insurance coverages, your deductibles, and your premiums. It may be time to shop around and save on your monthly premium without taking on too much additional risk. When it comes to building wealth and working on your financial foundation, always take into account other types of insurance. Other types of insurance include health insurance, flexible spending account, disability insurance, life insurance, and long-term care insurance. With health insurance, you're required to have coverage by the Affordable Care Act, an important part of work benefits and compensation that can significantly help your budget if you can get it through your employer. Then there's also flexible spending accounts, where you save pre-tax dollars in an account to cover deductibles, co-pays, prescriptions, and OTC, over-the-counter drugs, and other health expenses not covered by insurance. It can also be used for childcare. Disability insurance helps if you are sick, injured, and unable to work for a long time. Life insurance, in the event of your death, life insurance pays money to the person of your choice, your beneficiary. And long-term care insurance helps pay for health-related items like nursing home, assisted living, and in-home care. All of these types of insurance are made to help protect you and the wealth that you have accumulated. We'd like to leave you with some important questions. Now that you've gotten an overview of building wealth, how has your definition of wealth changed? Are your financial goals still the same, or do you foresee having some new ones? What strategies are you going to take? What are your next action steps? Here are some links to additional resources. You can find a Building Wealth curriculum on buildingwealth.org. Federal Reserve Education has some great webinars that you can take on finances. The next is the Texas State Securities Board that has some great resources on their site if you'd like to invest your money and how. Broker Check is a free tool that helps you make informed decisions about a broker or firm if you're wanting to invest. They provide information on a broker's employment history, licensing information, and more. Annual Credit Report offers yearly access to your report free of charge. You can view FICO reports through myfico.com. Federal Trade Commission has lots of resources on money and credit and expanding your wealth. If you're looking for information on how to freeze your credit, if you suspect identity theft or suspicious activity, this is going to be the Consumer FTC link. And lastly, check out our blog, Plano Library Learns, for additional budgeting resources. This concludes our presentation. Thank you for taking the time to attend our virtual program on building wealth. You can find more resources on our website, planolibrary.org, as well as our blog, planolibrarylearns.org. And if there are any questions, please let us know in the chat. Ellen is adding the links that we have touched on throughout the presentation today. And we'll also make sure to check if you're going to get a link. We're going to send you a link to the presentation and to a recording of this after the class is over. Thank you all so much for attending. We hope you have a good night, and we'll see you next time.